Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, retirement specialist and six-time author and fiduciary, Tony Walker.
Hello and welcome to the Worry-Free Retirement. I'm Trey Juergens, full-time fiduciary retirement planning specialist here in the Louisville office at Tony Walker Financial. Joined today by the other two favorite fiduciaries, Heather Hughes and Wes Walker. Good morning.
Good morning, Trey. How's it going?
Good. Today we're going to talk about something, it's one of the buzzwords in investing. Everyone knows they need to do it. No one really knows what it means. And we're going to kind of get into that. The word of the day is diversification. So I'll let both of you kind of your take on diversification in 30 seconds or less. Wes, what would you consider?
Yeah, so diversification in the sense of investments it's kind of like your Kevlar against major bad things happening to any one investment. Diversification just means that you take all your investments and spread them out so that you don't have major exposure to one thing. There's pros to diversifications, there's cons to diversification. The big pro is that any one investment that you make is not totally going to bring down the ship. The con is, though, that, some people like Bill Gates, the Warren Buffetts, the Larry Ellisons of the world, they've concentrated all their wealth into just one thing and it's done really, really well. But for the average person, particularly for those in retirement, diversification becomes very important to protect against major losses from just one single investment.
Yeah, good stuff. Heather, anything to add?
No, I agree. It's very much don't put all your eggs in one basket because of that. Like you said, if you invest in a single stock, it could pay off or you could lose everything. So diversification, especially in terms of retirement, has to be looked at differently.
Yeah, perfect. What we really wanted to focus on today is there's really kind of two phases of diversification. What we call the accumulation phase before retirement might even be a thought in your mind. Diversification is for just that. You want accumulation, you want growth, of course, with some hedging and protection against something detrimental happening, like Wes said. What we have here, the first article talks about the 60-40 portfolio. And historically, I'll let you all kind of speak to what that is and how yes, we still use some split of equities and bonds. Unfortunately, here lately with the interest rate environment, bonds haven't really held up to what historically has been a really good performing mix of equities and bonds. So in this article, I'll just kind of read some points and turn it over to you all. So historically, the 60-40 mix has offered downside protection during major events like Great Depression, the dot-com bust, even through 2008 and 2009 during the housing crisis. However, here recently, we've seen the worst stretch in over 125 years. If you all want to kind of speak to what's been happening with these bonds that have kind of dragged this historically well-performing mix down.
I think a lot of that has to do with current policies. The inflation that has been really high lately has really forced the Fed to keep interest rates up. And typically, when stocks are performing poorly, the bonds do better. This has not been the situation. So it's been, when we have a stock decline and inflation and the Fed is keeping interest rates high, it's pushing everything down.
Oh, yeah.
So this 60-40 mix, it means there's 60% in the stock market and there's 40% in the bond market. That's what the 60-40 means. In 2022 in particular is when we saw these big drawdowns from both stocks and bonds. The reason stocks went down is just people were less comfortable with, the economic environment. The prospects for business were maybe a little bit worse. But the bonds is a different story. It's because interest rates rose generally that bonds underperformed. And I think it's important to talk about why the Federal Reserve would raise interest rates. They're in control of all this sort of stuff. They set all these economic policies. What the Fed does is they take a look at inflation, and if inflation is high, the mechanism they have to combat that is to raise interest rates because it will curb borrowing, it will slow down economic activity, and hopefully stop the inflation from getting so persistent. But if you own bonds and interest rates go up, that bond that you held that was paying a certain coupon is not worth as much because now there's new bonds that are paying higher coupons since they've raised those interest rates. And that's why the value of them goes down. So to see both of them in tandem go down together, it can be a little off-putting for sure, if especially you're using the bonds for security and principal protection.
Yeah, and then in this next article, good stuff there, Wes, this speaks about how diversification, some people think when they jump into some index fund that they're truly diversified. But speak a little bit about, we're big believers in index funds for diversification. However, what are some troubles as you get closer to retirement in putting all your eggs in one basket?
Sure. So, index funds and major indices in general had become more and more concentrated as time has gone on. They used to not be so concentrated in the top names, but particularly with what they call the FANG stocks or the Magnificent Seven, these are kind of the top tech companies of the world. Their market capitalizations have become bigger and bigger, and most of these indices are market cap weighted. It just means that the biggest companies get the biggest percentage of holdings inside the index fund. So they've become less diversified because they're more concentrated into these top companies. As of late, it hasn't necessarily been a bad thing because those top companies have performed really, really well. We've seen huge gains in the market, but that can mean that the investor is less diversified than they were prior.
And there's some equal weighted funds, index funds now that are trying to spread the investment over, more equally over that investment in the fund.
Yeah, and I think that's important. Heather, this is what I wanted to ask you about. This next article, it talks about this retirement red zone. As we get closer with underperforming bond markets here in the last few years, it's pushed a lot of people maybe a little bit more towards equities than they kind of intrinsically need to be in equities. So if they have a little bit too much stock exposure as they get to this retirement red zone, they define that as the 5 years before and the 5 years after retirement. Speak a little bit to understanding risk tolerance and understanding how much equity exposure someone really needs to have as they enter this red zone.
Right. So a lot of people, their biggest investment vehicle is their 401k. And 401ks have tried to make it easy to pick what you're investing in through what's called target funds. And the target funds are basically a split between equities and bonds. And then it starts to inch closer to bonds the closer you get to retirement, which is great because we're trying to move to a little more conservative stance when you are approaching retirement. The difference is that basically, along with what Wes had said with, the dual pressure pushing stocks and bonds down, and especially in 2022, it's not necessarily the best place to be. So I know people that, they're 5 years from retirement, they want to grow as much as they can before they retire, but the risk they're taking on by staying a little more heavy into equities could really derail their retirement. If we have another 2008, which, I was working during that time and the market dropped 30% and you're heavily in equities, it could actually prevent you from retiring, which is sad. And we actually saw some of that happen back then. So, when you're getting close to retirement, I think it's really important that you talk to advisors and say, okay, here is where I am. Where do I need to be? This is my goal. This is my target retirement date. What can we do to shore this up?
Yeah, I think that's important. And as savers may be drifting more towards equities because they've done better here in the last few years, if you're approaching retirement, finding some bond alternatives and things is probably a better way to go. So I think getting a game plan, understanding as you approach retirement. We're going to head to a quick break. We'll be right back to talk about diversification as you enter into that retirement phase.
The following clients were not compensated for their testimonials of Tony Walker Financial. Their experience may not reflect the experience of all clients and is not a guarantee of future results.
Want to know what savers were saying right before the stock market crash of 2008?
At our age, we just don't want to be on the roller coaster of the stock market anymore.
I'm not satisfied with my mutual funds at all.
Stop putting your money at risk when you don't have to. Learn how to safeguard more of your retirement savings by logging on to TonyWalkerFinancial.com or call 877-499-9255.
Are you retired or retiring soon? Do you have a 401k, IRA, 403b, thrift savings account, or lump sum pension that you'd like to move to safer territory? Did you know that all the money you see on your 401k statement isn't really yours? Depending on your overall taxable income, the government has essentially a lien on your 401k that can tax as much as 40% of your money when you go to take it out. Tony Walker calls this the 401k tax tumor. For over 40 years, retirement specialist Tony Walker has helped thousands of savers worry less about money by creating game plans to deal with your tax tumor. Get control of your retirement by controlling the taxes owed on it. Schedule a free meeting to see if you can reduce your tax tumor and provide a guaranteed income you can never outlive. To get started, simply log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com.
Don't let the fear of running out of money in retirement keep you up at night. Turn your 401k into mailbox money for life by logging on to TonyWalkerFinancial.com or call 877-499-9255.
Welcome back to the Worry-Free Retirement. I'm Trey Juergens, full-time fiduciary and advisor here in the Louisville office, again joined by Heather and Wes. So we covered a lot about that diversification during accumulation phase when we like to help savers as they enter into that retirement phase. So we, again, in that same article we covered with the retirement red zone, as it comes time, those magic 5 years before retirement and after retirement, when it's time to really get a game plan in order. This article, similar to our split IRA concept, talks about a bucketing strategy. Everybody's using buckets now, so that's not something that's unique to Tony Walker Financial. Our split IRA concept, we feel, is unique to Tony Walker Financial. They use orchard and basket in terms of growth versus short-term income. This two-bucket strategy that we illustrate with the split IRA concept sometimes turns out to be 7 or 8 different baskets. It really just depends on the client's situation. So, Wes, we talked about the bond environment and the interest rate environment. Speak to what we did inside the Schwab portfolios as we kind of experienced what happened in 2022 with the bond issues.
Yeah, so, we try not to make too many changes to our portfolios. The science says that if you can kind of just sit in the things that you were supposed to be in the first place and wade through that turmoil, that you'll do pretty well. But we did have to make one tactical asset allocation change in that we shortened the duration of our bond portfolios about midway through 2022 with anticipated interest rate raises. We've talked about this before. Again, that sentence probably sounds like all kinds of nonsense, but we just made the bonds in our portfolio shorter because they're less sensitive to interest rates than longer-term bonds. Really, for the past, prior to 2022, the past 10 years before that, there was almost a war on savers. Interest rates were very low, and it's really hard for a saver, a retiree, to get decent yield or income off of their investments when interest rates are in that environment. So, although the rising interest rates really did affect people who held bonds already, this new environment of higher interest rates is actually really good for savers. It'll produce more income from guaranteed investments like annuity contracts or government bonds, that sort of thing. It does pick up a lot of yield for them. So although it was negative in the interim while they were going up, now that interest rates are up, it's actually a little bit of a better environment for those who are nearing retirement.
Yeah, that's good stuff. And Heather, we kind of teased a little bit before the break about these bond alternatives. What interest rates could we find out there that are safe, that are not going to scare savers with something that could have happened in 2022 with losing money on stocks and bonds? What have we been able to do in the last few years?
Well, thankfully, because of the higher interest rate environment, we've moved a lot of clients' assets, not entirely, but a portion of it, part of their plan, into what's called a MIGA, so it's a multi-year guarantee annuity. Works a lot like a CD. It's got a fixed interest rate for a fixed period of time, principal's protected, and that way they can get either immediate interest off of that or they can let that accumulate and compound. So it's been a really strong piece to the retirement puzzle as of late for clients.
I would say too, those in the guaranteed investment contracts, MIGAs, fixed annuities, whatever you want to call them, their yields, you should look at those and realize that that's kind of the risk-free rate. So a CD, a MIGA contract, a treasury bill, essentially a lot of these things are really what you're getting from not taking much risk at all. I've seen a few investment products marketed on TV with much higher yields, and they say that they're safe, not naming any names. But I've looked into some of these products, and then you find out what's behind those loans. Just one, for instance, was backed by defaulted student loans. So borrowers who might not be able to pay for their student loans are all kind of lumped together into these investment products.
Yeah, that's scary stuff.
I know it. Yeah, just if you're watching TV or there's anything pitched to you, just always be aware that if it's a lot higher than what the true risk-free rate is, there's probably a reason behind that, and it's something to look at.
Yeah, in working with savers, I think that split IRA, whether it's a very elementary illustration of a couple buckets, but understanding that liquidity and access on the front end that we can accomplish with Charles Schwab, utilizing different annuities, whether it's a MIGA, a fixed annuity, or income annuities for that beloved mailbox money. It allows us really to kind of check the boxes that these savers come to us looking for. And if that might be you out there looking for a game plan, you're entering that retirement red zone phase, kind of heading in, maybe you have a little bit more equity exposure than you'd like in that 401k, give us a call. It's 877-499-9255. Well, y'all stick around. We're going to be right back. We're going to talk about when we get into that split IRA concept, actually taking distributions in retirement. So hang around. We'll be right back.
The individuals in this interview are uncompensated clients at the time of filming. Their opinions expressed were provided to Worry-Free Productions for use as an advertisement by Tony Walker Financial. Please refer to Form CRS and Form ADV Part 2B disclosure brochure for information regarding the advisory services offered by Tony Walker Financial.
Our client spotlight today features Mr. Roy Ice here at the Worry-Free Retirement Studios. Mr. Ice, thank you for joining us today.
Thank you for having me here.
Well, first of all, tell us a little bit about your background in terms of your work years.
I worked about a little more than 30 years at Ford Motor Company and for the United Auto Workers.
And when did you retire?
In 2023.
And I know you've been with us a couple of years now. When did you begin working with Tony Walker Financial?
It was shortly after retirement, probably January of 23.
And what prompted you back then to contact us?
It was another coworker.
Oh, awesome.
Yeah, the coworker said how Tony Walker had been able to help her navigate the 401k waters. She spoke highly of the organization, and she said, Roy, it is worth a look. And I looked, and I liked, and I joined in.
And do you mind me asking a little bit about your past? I know you lost your spouse some time ago.
Yeah.
How has that transition been? How would you explain even the financial and everything else that goes along with losing a spouse?
Well, for 30 years, my wife, Julie, handled everything. Everything from every bill, every savings account, everything. And I was a complete fish out of water. I had no idea how to balance a checkbook or anything. I just knew that I had a pension coming in, and I knew how much money was going out. And I thought that that's the way it was going to be. I was very worried before I came to Tony Walker.
Being employed under a 401k, I'm assuming you had somebody there helping you manage your 401k, didn't you?
Yeah, well, the company had resources available to manage those for us. It was completely elective. It was fee-based. But other than someone managing that, you really don't have any more information than someone who isn't being managed. You don't have that information. So you have to put hope and faith and trust into the people that are doing it, that your market value or whatever your holdings increase in value. But I think at the end of the day, it just, to me, I lacked those resources. And then that's what Tony Walker offered me, that the resources were there. The books were written. The proof was in the pudding, and everything was laid out for me. And anybody can read through it and just know that it's the right thing to do.
And I think you were under the impression, like a lot of workers, that just because you were under the age of 60 and wanted to retire, that really that 401k, to your understanding, was kind of off limits. Is that correct?
Yeah, that's it's kind of ingrained into your head. If you hit it before 59 and a half, you're going to get a 10% penalty from the feds. It was eye-opening when I came here and learned that, I can avoid that penalty. and draw and subsidize my pension and live an even more healthier retirement.
So I was going to say, how's it been since you retired? Is cash flow, like it says, cash flow been good? Has it surprised you how little it really needs to get along in retirement?
What surprises me is that my concern that I had on finances went away. I don't focus on the finances. I know that if I have one of life's curves are thrown at me, I need a washer and dryer, or, I need some work on my vehicle, I know that it's there. I know that I'm not going to stress out and have to, save a couple months or whatever to get it done.
And speak to people who are under the age of 60. There's a lot of changes going on in society, Mr. Ice. What would you say to somebody that, let's say, is in that 55 to 60-year-old age range, and they really just assume they cannot retire? What would be your suggestion to them?
Well, I would say before you make that your final decision, that you at least get all the information that you can. I think Tony Walker Financial is a great resource for that give you a better understanding of if you can, if you can't, because there are so many things that we just don't know about. We just don't know about them, Tony. We work, we put money in the 401k, and then we think when we're 59 and a half, it's going to be there and we'll draw on it. There's a lot of information that the normal, regular working Joe doesn't know. And that's where you guys come in.
Well, Mr. Ice, we appreciate your business, and thank you so much for your trust and confidence in Tony Walker Financial.
Thank you.
You're
Thank
welcome.
you very much.
Looking for an advisor you can trust? Schedule your free phone call with Tony at TonyWalkerFinancial.com or call 1-877-499-9255.
Warning, a licensed insurance agent with no prior knowledge of annuities can legally toss your 401k into an annuity. Don't make that mistake. Log on now to TonyWalkerFinancial.com before ever purchasing an annuity.
Welcome back to the Worry-Free Retirement. This is Trey Juergens, full-time fiduciary retirement planning specialist in the Louisville office, here with Heather and Wes as well. What we're going to talk about now, we kind of got into the split IRA, how it allows us to diversify in retirement for our clients. However, what we like to talk about is using and enjoying your money. So I'm going to let both of you kind of hit on how are we selecting the investments for our clients in Charles Schwab? Where are we trying to diagnose their risk tolerance, and especially if our game plans that we lay out, these income plans that we put together for savers, do indicate pretty large drawdowns in the early years, how are we in choosing these asset allocations in the strategy? So Wes, I'll take it to you first. Just kind of talk about, first of all, our strategies in general, but if someone is looking to start taking some distributions, what will we select?
Sure. So like you said, with this split IRA concept, we typically will have what Tony calls a mailbox money annuity waiting in the wings that we're not going to take the income from for maybe 10 years or 15 years, some distant date in the future. So outside of that, we might have two other buckets of money with their retirement assets. One bucket in Schwab might be for near-term distributions. This would be what we call our liquidity bucket, where we can get money out at the ready. And that second Charles Schwab bucket might be more positioned for growth. So this is very goals-based in its approach. We've got specific designations for these accounts because they have different purposes. Let's talk about that first Charles Schwab bucket, that liquidity bucket, where we'll be taking those first distributions from. The way we would typically invest that is pretty conservatively. So it might have some very low duration bond exposure, some money market cash exposure, maybe a little bit of stock market exposure, but it would not be very aggressive because we don't want that sequence of returns risk. Sequence of returns risk just means that you might see a drawdown in the account, the asset values could fall, and then you take money out of it, kind of hitting yourself while you're already down. So you don't want to do that with money that you have a near-term distribution need for. That's that first bucket in Schwab. That second bucket that we've positioned for growth, that would be more stock market heavy. That would have more risk per se, but the time horizon is longer for that goal. They might be saving that for 10, 15 years, or they might be leaving a legacy to grandchildren or something like that. So we do have the ability to put it more into stocks, take more risk with it, because we don't need to take money out of that bucket. Heather, anything that you would say when we're looking at somebody's case and taking money out versus leaving it in?
No, I think you're spot on there. I think the way we typically structure things is, as you mentioned, we start with Charles Schwab first as the liquidity bucket. Typically the conservative, just what you had said. Once the Schwab is depleted or almost depleted, then that's when we start looking to the annuities and starting to access those. So, like you said, that duration time, at least a lot of times it's at least 5, even 10 years that we'd be drawing from Schwab. Then we switch over oftentimes to the income annuity that will provide the guaranteed lifetime income for the client. So once they kind of reach that part of their retirement journey, that's going to be kind of so almost switching to autopilot, because it's things that they don't have to worry about. They don't have to worry about the particular investment because it's providing that guaranteed lifetime income for them.
It is interesting too. Like when someone retires and they move over to our firm, I mean, there is a pretty decent drop in equity exposure with the purchase of that annuity contract, with this money set aside for near-term distributions. It could be a decent size reduction in what they have in the stock market. And we've proven that that's not necessarily a bad thing. Some investor types may look at that and say, I'm not getting the rate of return that I, really require to feel good about my investments. But our practice is way more based on the goal of enjoying the money in retirement and less so about the numbers of how much rate of return did we get on these investments throughout the years.
And I think that's the difference that a lot of people don't understand is when you're in the accumulation phase, when you're working, you're geared towards growth. Once you retire, distribution planning is completely different from accumulation. So rates of return are not necessarily as important as they were before, as long as you've got the proper vehicles to provide the income that you need in retirement.
And that's important because when you're young, the rate of return is very important. When you're 25 and you've got a 30-year time horizon before you're even going to start to look at using this money, you do not want to be in short-term fixed income investments. That's a terrible idea. You want to be out there in the market taking the risk because you can stomach it, and it's going to give you that big pot of money that you eventually one day can turn over to a trained retirement specialist to set up a game plan and show you how to actually use all this money. But I think your time in life is very important. What stage you're in, that's what really determines your investment mix, and less so rates of return.
Yeah, very much so. I think it is that philosophy switch. And I think as Tony preaches with the live well, die broke philosophy and always talking about using and enjoying money, the people that come to us with the idea of just drawing out 4 to 5% and protecting the principal, you may be able to do that. But if you have a game plan that allows you to use and enjoy this money, knowing on the back end that you're not going to run out, that's really when savers kind of get that aha moment when we present a plan. So if that's you, if it sounds like you have this 401k or IRA that's sitting out there, you don't really have a plan for how to draw that down and use and enjoy it, I think it's time for you to possibly sit down with us and get a game plan together. Like Wes said with Charles Schwab and with our game plans in general, you may have a lot more equity exposure than you can stomach. And with these drawdowns and not a game plan in place to use and enjoy this money, as Tony says, you might be like a ball in high weeds, or what is it? The lost ball in high weeds?
Lost ball in high weeds. There's one more thing I would add too, is we've so far just talked about assets that people have with Tony Walker Financial. If you've got Social Security on top of this, maybe you've got a pension through your employer, those are other pieces of the puzzle that need to be incorporated in the plan. If you've got all sorts of pension assets, you probably don't need a mailbox money annuity. You might, but that kind of decision making, I think, is where you can bring us into the fold, and we can really help to diagnose what makes sense for you. So Trey, like you were saying, if those folks want to come in, we'd be more than welcome to talk to them.
Yeah, and it's not cookie cutter. And we develop plans on an individual basis. And oftentimes we'll see clients that are a little hesitant and they move forward and they're like, oh, now I'm becoming worry-free. I get it. So to take all of that off the table for them where they have to worry about where they're investing and letting us take care of all the heavy lifting, I think is really beneficial.
Yeah, I think one of the things, and we see more and more clients in these client reviews that have been clients for 20 plus years, and they're getting to a point where they don't need this money that Uncle Sam is making them take out due to RMDs. They keep saying, oh, I wish I would have taken more and enjoyed more earlier, done more traveling. With a game plan, you can do that. So again, the importance of a game plan is paramount. If that's you out there, feel free at any point just to give us a call at 877-499-9255. Until next time, appreciate y'all tuning in. Heather and Wes, thank you.
Well, Trey enjoyed it. Thanks for having us on.
Yes, thanks, Trey. It's good taking over the studio from Tony occasionally.
Absolutely. And we'll see you all next week.